Welcome to the Deep Dive, your shortcut to getting smart on earnings calls.
Glad to be here.
Today, we're digging into the Q2 2025 results from Wallbox NV. They're a really interesting player in the EV charging space.
Absolutely. Sitting at a fascinating point right now. Lots happening.
So our mission today, unpack the numbers, look at their big strategic moves, and figure out what management thinks is next.
Yeah, and specifically, can these new energy management ideas really help them navigate, some tough market conditions?
That's the core question. Let's dive in.
It's a compelling story for sure. Wallbox is dealing with a tricky industry overall, plus they're trying this ambitious pivot, moving beyond just chargers.
Right, becoming more of an energy solutions company. We'll look at the numbers first, then connect those dots to the bigger vision.
Sounds good.
Okay, so the Q2 snapshot, honestly, kind of a mixed picture, wouldn't you say?
I think that's fair. You see some really strong operational control, which is definitely a plus.
But that came alongside some real revenue challenges.
Exactly. Revenue was $38.3 million. Now, that was inside their own guidance range.
Okay.
But it missed what analysts were expecting by about $4.8 million. And maybe more importantly, it's down 22% from last year's Q2.
Which was a record quarter for them, right? So a noticeable drop.
A very noticeable drop, yeah.
But then, the bottom line, things get a bit more interesting there. A positive surprise, actually.
Yeah, the gap, or IFRS earnings per share, came in at negative $1.92.
Which sounds bad, but it beat the consensus estimate.
By a good margin, about Syrian 79 cents. So yeah, despite less revenue coming in, they managed the costs better than expected.
That's a crucial point. And gross margin, did that hold up?
It did, held steady at 37.8%, right in line with their guidance.
Okay.
And the adjusted EBITDA loss. And this really stands out. It actually improved by 33% compared to last year, landed at negative $7.5 million.
So that suggests their cost-cutting push is actually starting to work.
It really does. A strong signal they're getting a handle on expenses.
And operationally, they did flag some good news too, right? Some bright spots.
Definitely. North America AC sales were up 21% just from Q1. Plus, they sold 140 of their Supernova DC units. That's up 33% quarter over quarter.
And the big one, efficiency-wise, the reduction in OPEX.
Huge. 25% lower labor and operating expenses compared to last year. That's a serious effort to streamline.
That really is. It's interesting, though, you mentioned the market reaction was kind of cautious.
Yeah, the stock dipped after the call. Seems like investors were maybe more focused on that revenue miss than these efficiency gains.
Which maybe tells you something about what the market values right now. Top-line growth seems key.
It certainly seems that way. They're scrutinizing that growth path very closely.
Okay, perfect time to transition into the deeper dive on those financials and the efficiency push. You said $38.3 million revenue, a bit better than Q1, but down year over year. Where's that coming from mainly?
Geographically, Europe is still the big driver. That was 68% of the revenue, about $26.1 million. North America brought in 30%, or $11.4 million. They mentioned Europe is picking up steam again quarter over quarter, especially places like Spain and Italy.
And North America, holding steady.
Yeah, a strong contributor, even though the overall EV market there softened a bit in Q2.
Let's talk more about that cost control.
Yeah.
It seems absolutely critical for them right now.
It really does.
But when a company cuts costs that much, 25%, maybe even 35% on a cash basis, as you mentioned, is there a risk? Are they cutting too deep?
That's always the question, isn't it? They achieved that 25% reduction overall. And yeah, if you strip out things like R&D capitalization, one-offs, the cash cost reduction was even bigger, 35% year over year.
Wow.
Management argues these are strategic cuts, like streamlining ABL after the acquisition, getting those synergies without hurting ABL's revenue.
Makes sense.
They did admit, though, that OPEX ticked up slightly this quarter because of some unexpected freight and tariff costs, mainly due to strong U.S. demand. They plan to manage that better.
Okay, so mostly planned efficiency with some unexpected bumps.
Right. What the market's definitely going to watch, does this impact future innovation, future growth? It's a balance.
And good to see the gross margin was stable, 37.8%.
Yeah.
What are they expecting there going forward? Can they improve it?
They seem to think so. They talked about shipping new inventory that's cheaper to build, optimizing the bill of materials.
Okay.
Plus some strategic price increases in certain places. It's about improving the product mix and just getting more efficient overall.
So with all this work on efficiency and margins,
Wow.
How close are they actually getting to profitability? Adjusted EBITDA break-even seems like the big target.
Yeah, that negative 7.5 million adjusted EBITDA loss was a 33% improvement from last year, so progress is being made.
Definitely positive movement.
And management was very clear. They are committed to hitting adjusted EBITDA break-even in the near term. They called it a critical credibility milestone.
You can see why investors would focus on that. Now, shifting gears slightly, the balance sheet, cash position, debt, that's always key in this industry.
Right. They ended Q2 with about 32.4 million in cash and equivalents. Total debt was around 182 million.
Okay. How's that debt structured?
It's about 80 million long-term, 102 million short-term. It is up about 9% from Q1. But the CFO made a point of mentioning an 18-month interest-only period on most of their loans.
That gives them some breathing room then.
Exactly, some flexibility while they navigate this transition.
And operationally, inventory management. Sometimes that ties up a lot of cash.
They've made really good progress there. Inventory is down 33% compared to last year, and 11% just from Q1, now stands at 56.6 million.
That's significant, shows better efficiency.
Definitely. Tighter control over working capital, which frees up cash.
We also saw some financing activity this quarter, a private placement.
Yes, they raised $15 million. What's interesting is that over $9 million came from SET, which is a Spanish government-backed tech transformation fund.
Oh, interesting. Government backing.
Yeah, alongside existing investors, Iola and Oria. It's not a huge amount, but it extends their runway a bit, and it's a nice vote of confidence, especially from SET.
And finally, on the housekeeping side, but important, regaining NYSE compliance.
Crucial, yeah. They did that 1-for-20 reverse stock split back in July.
Right.
And then announced they were back in compliance with NYSE listing standards in August. Takes away a big uncertainty that was hanging over the stock. Procedural, maybe, but really important for investor sentiment.
Okay, let's move past the pure numbers now to the really exciting part, the strategic innovations. What's happening on the product front that could really change things? I'm especially curious about that bidirectional charging.
Yeah, absolutely. The big highlight was definitely the first commercial installations of their Quasar 2 bidirectional charger.
Quasar 2, yeah.
They did this in California, working with Kia and UC Irvine. And this tech is, well, it's potentially a game changer.
How so? It lets the car send power back.
Right. Exactly. Not just charge, but discharge power back to your house. That's V2H, vehicle to home, or even back to the grid, V2G.
Wow. So like blackout protection from your car.
Precisely. They mentioned a Kia EV9 with its big battery could power an average home for 1 to 3 days. That's real peace of mind.
That shifts the whole value proposition of an EV, doesn't it? It's not just transport. It's a home energy asset.
Totally. And you can do smart charging based on electricity prices, too. The CEO called it a very important potential revenue growth area. They want to ramp up deliveries significantly, aiming for over 100 units a quarter by Q4.
That's genuinely transformative tech. What about the virtual power plants, the VPPs? How does that fit in?
It fits perfectly into that smart energy vision. They launched VPP programs in California and New York with a partner called Leap.
Okay, what does a VPP do?
It basically links together thousands of residential chargers, turns all those individual EV batteries into one big controllable energy resource for the grid.
So users can help the grid and maybe get paid for it.
Exactly. Users can earn incentives, and the utility gets flexibility to manage peak demand, integrate renewables better. It's a smarter grid in action.
And a new revenue stream for Wallbox. Recurring revenue.
That's the goal. Expanding software and grid service revenue.
Makes sense. Well, they're also building out commercial partnerships, right? That's key for growth.
For sure. They mentioned a deal with PowerGo in the Netherlands, putting their EM4 and Supernova DC fast chargers in hotels.
Okay.
And in the U.S., they're expanding with a partner called Ensol into DC fast charging infrastructure in Texas, Florida, and Georgia, using the Supernova charger, planting flags in new areas.
What's the latest with the Generac partnership that's been running for a couple of years now?
Still progressing. You've got Wallbox home chargers being sold under the Generac brand in North America, integration of apps and platforms.
Right.
And in Europe, they launched a new solution using Supernova chargers combined with industrial batteries and Wallbox software under Generac's Framac brand. It helps charge point operators where grid power is limited.
Sounds useful. Any sense of the pace?
Management actually said they'd like to see integration and deployment move even faster. So progress, but maybe still more potential there.
Got it. And the ABL integration. We talked about the cost cuts earlier. Was that successful?
Seems like it was, yeah. They hit that target of at least 40% reduction in personnel and OPEX costs at ABL over the last year,
while keeping revenue stable.
while keeping revenue stable. And they're now successfully cross-selling ABL products, like their double-socket commercial chargers, outside Germany. That's bringing in over €1 million per quarter now.
That's a good example of integration working then.
It really is.
Yeah.
Smart integration paying off.
And how about software and services overall? You mentioned VPPs, but how's that segment doing generally?
It was actually their best performing area in Q2, grew 27% year over year.
Wow.
It now makes up 20% of their total revenue, about $7.6 million. A lot of that growth came from ElectroMaps, their public charging access service, especially as demand grows in Europe.
So that strategic pivot towards software is showing results.
Definitely gaining traction. It's a key indicator to watch.
Okay, let's zoom out again. Look at the market picture and Wallbox's outlook. What guidance did they give for Q3? Does it reflect this story?
For Q3, they're forecasting revenue between $38 million and $41 million, so potentially flat to slightly up from Q2.
Okay. And margins.
Profitability.
Gross margin expected between 37% and 39%. And the adjusted EBITDA loss is projected between -$4 million and -$6 million.
Which is actually an improvement from Q2's -$7.5 million.
Exactly. So the guidance shows continued focus on cost control and inching closer to that break-even point.
How are they reading the tea leaves on regional EV markets? There's been so much talk about slowdowns. Do they still believe the transition is irreversible?
It's definitely a mixed regional picture. Europe, they say, is showing a strong recovery, grew 30% year over year in Q2, helped by more affordable EVs and government support.
They see that as a tailwind then. Yeah, especially in places like Spain where EV sales were strong. North America, though, the market growth actually slowed, down 5% year over year in Q2.
Why is that? Subsidies changing.
That's likely part of it. Loss of some tax credits, changing emissions policies. It creates volatility. But Wallbox still feels confident at their U.S. growth because of their partnerships.
So they're banking on their strategy, even if the overall market wobbles.
Right. They stress their global footprint, and flexibility lets them adapt. And yes, they maintain the global EV shift is irreversible, even with these regional bumps.
So in this tougher environment, where peers might be seeing slower growth, maybe pricing pressure, how does Wallbox stand out? How do they avoid just being a hardware commodity?
This is where that strategy really comes into play. They're leaning hard into software, services, and their DC fast charging like Supernova. The goal is to defend margins and offer more than just the box.
Add value beyond the hardware itself.
Exactly. Avoid that race to the bottom on price.
Which brings us to the long-term vision. What's the end game here?
It's a multi-year shift, moving from being seen as just a hardware-first company to becoming a genuine energy management platform, monetizing software, monetizing services across all their chargers, AC and DC.
And hitting that adjusted EBITDA break-even.
Yeah.
That's the next big step to prove the strategy is working.
That's what they called the next critical credibility milestone. It's key for investor confidence as they execute this big pivot, building a more sustainable, higher margin business.
Okay, so context for you, our listener.
No.
The market's reaction right after the Q2 call was, well, pretty cautious.
Yeah, the stock dropped about 4.8% the day after the call, on higher volume too.
Which suggests investors were maybe zoning in on that revenue miss and the somewhat conservative Q3 guide.
More than they were rewarding the operational improvements or the strategic stuff like Quasar 2.
And looking longer term, the stock has had a rough ride, right? Down significantly over the past year, even after that reverse split. UBS kept a neutral rating, cut the target to $6.
Right, so the sentiment is definitely cautious, maybe cautious constructive at best right now.
So what this deep dive really shows you is a company in the middle of a major transition. You see Wallbox getting much better control over costs. That's clear.
And they are making real progress on these new initiatives, bidirectional charging, VPPs. These aren't just ideas anymore, they're starting to happen.
And those are absolutely crucial if they want to build that recurring revenue, differentiate themselves from just selling hardware.
But, and it's a big but, the market skepticism right now comes down to that top-line growth slowing down.
Can the strategy actually re-accelerate revenue? That's the key question.
Exactly. Will these cool innovations translate into dollars and cents quickly enough? That's what investors need to see. You'll want to watch Q3 results very closely.
Any new orders for DC chargers, like Supernova?
Yep. And especially any hard evidence that the VPPs and Quasar 2 are actually generating meaningful revenue. Proof points are needed.
Okay, which brings us perfectly to our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade idea based on everything we've just discussed.
All right, so you've got Wallbox stock under pressure, the EV market's a bit soft macro-wise, and everyone's fixated on revenue growth, maybe overlooking the efficiency gains.
Okay, setting the scene.
So here's the play. What about a short-term but high-conviction, long position in Wallbox, maybe using deeply out-of-the-money call options?
Whoa! Out-of-the-money calls. That's betting on a big move up.
Targeting a potential rebound late Q4 this year, maybe early Q1 next year.
Okay, the outrageous part is obvious. Betting against the current trend, betting against that revenue misreaction.
Yeah.
What makes this remotely plausible?
It hinges on Wallbox hitting several of those credibility milestones we talked about and hitting them relatively quickly in succession.
Like what specific?
First, that Quasar 2 ramp up. Management needs to actually deliver on getting over 100 units out per quarter by Q4. Show that bidirectional tech has real commercial legs.
Okay, proof point 1.
Second, clear evidence of monetization from the VPPs with Leap. Show that the software and services model can generate real recurring cash flow, even if it's early days.
Proof point 2. Makes sense.
Third, maybe the European EV market recovery is stronger than people think, providing those tailwinds management hopes for, boosting AC sales beyond that Q3 guidance.
A macro assist.
And finally, the big one, actually hitting adjusted EBITDA break-even in the near term. If they achieve that, it could fundamentally change how the market views the company's viability and trigger a serious re-rating.
So the trade is basically a bet that their strategic pivot works, and works faster and better than the market currently thinks, shifting the narrative from cautious to growth.
Exactly. It's a bet that the energy management platform story becomes real and tangible sooner rather than later. High risk, obviously, but you can see the potential catalyst path.
Definitely food for thought. Okay, let's recap Wallbox's Q2.
A really nuanced picture. You had the revenue miss, which worried the market.
But tempered by really strong operational control, stable margins, and these significant strategic steps forward with Quasar 2 and VPPs.
The market's reaction, though, signals it's in wait-and-see mode. Show me the growth. Show me the money from these new initiatives.
Right. Cost control is good, but it's not enough on its own right now. However, Wallbox is clearly executing this shift towards being an energy management company.
It's a move designed to make them stand out in a crowded field. And honestly, if they pull it off, it could really change how we all think about EV charging and its role in the energy system.
Absolutely. Now remember, everything we've discussed here is purely for informational purposes. It is definitely not financial advice.
Please do your own research before making any investment decisions.
We hope this deep dive gave you a clearer understanding of where Wallbox is and where it might be heading. As you think about their future, what really stands out to you?
Yeah, is the market maybe missing the long-term potential of this energy platform they're building? Or is that near-term revenue slowdown the more important signal right now? Something to ponder.
Until next time, keep digging deeper.
And keep connecting the dots.